good evening. It's 5 p.m. on the clock, which means it's time for our Rise with India Prime Time with me, Mubina Kapasi. And we kickstart Rise with India Prime Time with the Money Show, your one-stop destination for all money matters. Here's what we have lined up for you over the next course of the hour. Alternative investment funds. Now, I'm sure a lot of you guys must be wondering, equity funds itself are pretty complicated with all its jargon. So now where is this alternative investments coming in from? Well, we're going to be unjargoning or de-jargoning it for you in the next 2 odd minutes. So stay tuned for that. And we're also going to tell you how risky they are, what sort of a return expectation should investors as well have. Also, are you hit by the PMC banking saga, or even worse, you have your money in other cooperative banks? How should you check then if your cooperative bank is safe? We will give you a checklist of sorts, if you could call it that, to check whether your cooperative bank is safe, and if not, take your money out instantly. And finally, Scriptbox has conducted a very interesting survey on the most popular investment tools for women. Surprise, surprise, it's gold and real estate. Well, we will be talking to the management of Scriptbox on the survey conducted. But before we do all of that, a quick look at the headlines. India needs a vibrant stock market and we need to increase retail participation in the market, says Finance Minister Nirmala Sitharaman. Speaking on the sidelines of an NSE event, FM says the realty sector needs a lot more attention and the government is working with the RBI to tweak the norms in order to save the home buyers. NASSCOM startup report expects India to have over 95 unicorns by 2025 as against 25 today. NASSCOM says early stage funding has picked up this year while seed funding is still struggling. Startups have created over 1.3 lakh plus jobs in 2019 and investments have reached 4.4 billion, which is a growth of 5%. Suzuki Motors issues a profit warning for the Indian arm after second quarter earnings. Predicts a 20% drop in Maruti's FY20 sales amid the demand slump. Japanese car maker posts a 32% slump in operating profit, which is the weakest in nearly 3 years. CBI carries out searches at nearly 169 locations across 15 states, including Delhi and Gujarat. Raids are in connection to 35 bank fraud cases to the tune of 7,000 crore rupees. Jet Airways heads towards liquidation. Sources suggest the lenders may discuss disposing of assets in the next meeting. In fact, the DGCA may be looking at giving away its slots permanently to other airlines. That's an ET now exclusive. Okay, well, those will be the headlines we're tracking for you all evening on ET now. But back to the topic at hand. And this is something we've not touched on before. Alternate investment funds. I'm sure the name itself sounds pretty complex and for a lot of you sounds pretty, big as well. But don't worry, we are here to de-jargonize it, if you will, for you. So to do that, we have with us Feroze Azeez, the Deputy CEO of Anand Rathi Private Wealth Management. Feroze, always a pleasure having you with us. Like I mentioned, right, I mean, for all our retail investors out there, they'll say, hey, listen, there are enough jargons in equity mutual funds, and now you're throwing in another instrument in the mix, and that's alternative investment funds. Yeah. So we'll try our best to, of course, simplify it for our viewers. But first up, what exactly are they?
See, alternate investment funds are a regulatory platform which is far more flexible than a mutual fund is. A mutual fund has several restrictions for the fund manager to invest in this and not invest in that. So AIF is a more broader platform where there is a bigger canvas given to the fund manager to manage return and the risk as well. So that's an alternate investment fund. So of course there are several categories in it. In fact, to be specific, there are 3 categories in it. So basic concept of an alternate investment fund is to try give a bigger canvas to the fund manager to do things which the mutual fund fund is not permitted to do, because retail investors are in huge numbers in the mutual fund, and their capability to interpret these nuances of complex financial instruments might be difficult.
So can retail investors, I mean people who are obviously, they may not necessarily be HNIs, etc., can they as well put their money in an AIF or no?
No, they can't, because the entire purpose of the regulator is to make sure whoever is buying whatever is buying or she is buying, they understand it. To restrict retail investors, they've kept the threshold high enough that retail investors can't actually put in, and the threshold is 1 crore Indian rupees. Of course, it might not be all at once, but you have to commit at least to 1 crore to an AIF to be actually be able to invest in one of those.
So I'm assuming that means it's more riskier as well than your traditional equity mutual fund?
No, actually it will be wrong for me to say that, but there are some of those AIFs far riskier. There are some very safe AIFs as well. Just like a mutual fund is a platform, you can have a liquid fund and a sectorial fund, which are diametrically opposite ends from a risk perspective. So could the AIF have a very, very safe strategy to something which can be as aggressive as it could get.
Okay, but a minimum commitment of 1 crore, it may be staggered over a period of time based on perhaps the call of the fund manager. What about returns? I mean, if it comes along with it, the sort of freedom and perhaps limited regulatory restriction for the fund manager to play around with, I'm pretty sure that is something then that would be able to generate better returns?
See, I think at least data says otherwise. For 3-4 reasons. Okay, I personally think AIFs are something which you can do without in your portfolio. One reason being, every time you take an extra step in risk, it generally does not or may not remunerate you with an extra step in return. It's just the perception that if I take extra risk, I get more return. That's why sometimes you have callers saying that I don't mind taking extra risk. So there is a threshold beyond which risk is meaningless. So I think AIF crosses that threshold and does not substantiate the higher risk it takes in most cases. Point 2 is the regulatory framework in terms of who can start an AIF is far more liberal than I would as an advisor want it to be. Now, if somebody has to start an asset management company, the kind of depth and kind of regulatory requirement to be able to start a mutual fund house is very, very different than an AIF. So you have quite a few aspiring fund managers registering as AIFs, and there is hardly any filter in terms of who can actually become an AIF fund manager. So these kind of, so for example, the latest information is 47 new aspirants of AIF are pending with SEBI for approval, and most of them end up going through with approval. So it actually scares me in terms of the pedigree these fund managers bring to table, because you have totally 42 asset management companies and you have 47 in the pipeline on the AIF side, which I think can balloon into something which might not be as efficient for people's portfolios.
And you're asking for 1 crore at least, so I think it's a pretty scary perspective. Is there any specific treatment for taxation, or is it taxed like a regular equity mutual fund, or perhaps a little more? Because like you're mentioning, if the fact that an investor has to put in a minimum 1 crore, which clearly puts him in the ultra rich category. So is there anything on the taxation front?
Yes, the tax is very different. In fact, there are 3 categories. So before we understand taxation, each category has a different taxation. So it's not one size fits all from a taxation standpoint. Category 1 and category 2 are closed-ended in nature. So they lock in the money minimum for 3 years. And so category 1 is more of the social impact kind of a category. Category 2 is where 69% of the total 3 lakh crore committed has been invested. So the most important category, if you have to arrange them in the chronological order of the assets committed, will be category 2, where people have locked in their monies. So category 3 is more or less a pass-through taxation. Category 2 is taxed at the fund level. So that's how it works. Category 3 is pass-through taxation, by which I mean for a retail investor. If the fund manager buys an instrument and on your behalf, the tax is going to be dependent on your tax bracket. That's called pass-through, as the name suggests. In a closed-ended format, which is AIF2, the taxation is at the fund level, not at the investor level. So that's a non-pass-through. So it's very, very complex, and I think the complexity doesn't merit inclusion in the portfolio. But it's interesting to see Why has this industry caught up so vastly? And if I have to be very candid about it, it was a 9,500 crore industry in April 2015.
Okay.
So it's gone up 30 times, which is almost 3,000% in size in the last four and a half years. I think it's largely because of advisors not being able to earn too much commission on the mutual fund side. And April 2015 is when mutual fund commissions were capped to 1%. Today, these funds still offer 5-6% upfront commission to advisors, and that has been one of the primary reasons why somebody is advising this, is what the research says.
Okay, so that means would the cost, or what you call in mutual funds expense ratio, would that be perhaps higher as well in an AIF?
Yeah, AIF actually has different format of costs.
Okay.
So that makes it even more complex for a person to understand. That's why it's good for retail investors to not be a part of it. Fortunately, they can't be. So the one fee is the management fee. Then you have administrative expenses, which generally are costs incurred by the fund manager. Then you have a profit share mechanism. So if there are profits beyond a certain threshold, then you end up parting with a portion of your profits to the fund manager. So all these three put together, it becomes quite high. From a cost standpoint, the lock-in of 3 years enables the fund manager to remunerate the advisor because there are no caps on upfront commission.
Okay, all right. Well, folks, you could consider it as a good luck charm of sorts that you cannot invest in a retail investor. Perhaps, of course, if you guys do as well have a crore to spare, still Feroze advises that stay away. There are various other kind of instruments out there that you could put your funds in, which do not have so much of complexity and jargons involved, much more easier to understand. And you know, sometimes regulations and restrictions are for the benefit and for the transparency of the investor itself. So don't look at every SEBI regulation and restriction negatively. They are at the end of the day doing it for the benefit of you know, investors like you and me, and that's the reason why, like Feroze mentioned, an AMC, an equity AMC, does carry along with it its whole host of permissions, you know, before you actually become an AMC as opposed to an AIF. So that as well is something noteworthy. Feroze for now gives his thumbs up to traditional funds. By the way, another point actually we've missed out on, Feroze, is liquidity. I mean, when I want to sell an equity mutual fund, I simply, you know, go and redeem it, or I pause my SIP, so on and so forth. What about these AIFs?
See, AIF category 2 is completely illiquid, so you're locked in for 3 years.
Locked in for 3 years,
If you actually derive some learnings from the closed-ended funds, even on the mutual fund side, they have not done well at all. Open-ended funds have done well. So even on the traditional platform, locking in your money doesn't make sense. So on an AIF, I think it is far-fetched to lock in your money. So liquidity, they don't win at all. On risk-adjusted return, they don't win. Taxation, they don't. Complexity, they don't. Expense, they don't. So I think there are enough negatives. I think it's important to make sure that if you get into an AIF, and quite a few of them would have got in as viewers, because that's why there is 3 lakh crores, it's important to understand whether there is something which is a Me Too product. If you are buying stocks using an AIF platform, then definitely don't do it. So there is a large portion of AIFs who do nothing but just the mutual fund bit on an AIF platform to charge more. So that I think you have to be very, very circumspect about. People do pre-IPO funds, investing in stocks which are expected to be listed. And I think there are so many risks which an investor doesn't understand in pre-IPO, angel fund and all that.
You know, we often get very lured, right, that, oh, the private equity guys and the angel investors have made that whole meat of the money, and, you know, the retail investors are left skimming at the top. And I think that's something perhaps that may entice a lot of investors. But yeah, for now, of course, it does not tick any of the boxes in the checklist for investing in them. But on that note, now let me invite all the questions and queries from our viewers, as we usually do on our Ask the Money Show segment. The numbers appearing on the top of your screens, 24990300, or you can always email us on themoneyshow@etnow.tv. Let's take on board our very first question. Mr. G.V. Reddy, he's been emailing us for the last 2 days, and we'll take up your query now, sir. He's from Hyderabad, and he writes into us saying that I have purchased AB Sun Life Pure Value Fund, 4 lakh rupees at an NAV of 56 rupees. Does not look like it's performing well. Want to switch to another mutual fund, but within Aditya Birla Sun Life. He also does have a couple of other funds as well. There's the Kotak Multicap, Mirae Emerging, using IDFC Sterling Value Fund. There's 10,000 rupees in each of these via an SIP, and if he wants to know essentially if these funds are fine. Now, unfortunately, Mr. Reddy hasn't shared a bit of background about himself, but you know, Feroze, a lot of our viewers have this AB Sun Life funds, and it's not exactly in its heydays at this point of time. Would you recommend that he perhaps consider moving out? It's a 4 lakh rupee bulk investment in this one.
See, I think definitely Aditya Birla Pure Value Fund has been on my exit list for the last 4 years, and I would still continue saying that the trough is not here, because once a fund gets into an underperformance cycle, which is driven by exits, then it becomes very difficult for the fund to revive. So I would say it's gone into that cycle, vicious cycle. So I would exit if I was you. Would I be restricted to reinvest my money in the same fund house? I wouldn't be doing that, because it's so easy to get out and get into another fund house, especially without cost and without tax, because tax might have got grandfathered last year. So long-term capital gains, you would be exempt in an underperforming scheme. So do that, and importantly, let me give you some schemes. Invesco Growth Opportunities could be one. Point two is you can definitely look at Kotak Emerging Equities Fund, and the third fund definitely Mirae Asset Large Cap Fund. These are the few funds which you can definitely consider adding in your portfolio to make it contemporary.
Okay, not exactly the best idea to switch within the same fund house. And yeah, Feroze has been having an exit or a sell, if you will, on the AB Sun Life Pure Value Fund, not been doing well either. So yeah, that's of course the recommendation from Feroze. Let's take on board our next query. We have Kalyan. They're writing into us saying, please advise 2 debt funds for a time period of 1 to 1.5 years and 5 to 6 years of holding period, for SIP of a working professional and later a lump sum investment of a pensioner respectively. Now again, you know, let me just tell all our viewers that when you do send in your profiles, it's best that you send us all your investments so we can take a holistic approach to it. We don't know yet if Kalyan does have any equity mutual funds in his basket at this point of time, but he is interested in debt funds. So Feroze, he's a working professional, but he also wants to put it later when he becomes a pensioner. I'm assuming that must be for his father. But yeah, what would you recommend he do?
Yes, I think, Mubina, you've raised a very valid point, that people try and do investments piecemeal. Something as complex as investments, I think, has to be looked at holistically. You can't look at it transactionally. You have to put a strategy in place. So taking any advice by giving part information, the propensity for the advice to be incorrect is very high, because the context is not known. So draw up a context before you take advice, not just from Money Show, but any friend of yours, any advisor of yours. It's very important to give information. That's point one. Point two debt funds, let me state for you. HDFC Credit Risk Fund and Kotak Medium Term Fund could be good funds which will diversify your money, especially in the credit environment we are in. It needs to be spread thin enough. On the equity side, you can look at Mirae Asset Large Cap and Kotak Emerging Equities, large and mid cap kind of exposure. Both fund managers are very good. Pankaj Triburwal on the mid cap side has done a phenomenal job in trying to pick businesses much before we could have identified them as a broader market.
In fact, tomorrow in our Meet Your Fund Manager segment, we will be talking to Pankaj Triburwal on his Kotak Small Cap Fund. So stay tuned for that. You know, just a quick point I want to raise. He said he wants to redeem them in 1.5 years. I think that would attract taxation as well, right? I mean, it would not be considered as an LTCG. So if you want to make a point to him,
correct. I missed that. I think it's an important point to be highlighted. In debt, 3 years is what it takes. 1,097 days is what it takes for a fund to be in the long-term category. In the short-term category, whatever gains you get and accrue to you will be added and be taxed as per your slab rate, marginal slab rate. So that's why it's important to hold a debt fund for 3 years. If you're not going to hold it, then the difference between holding an FD and the debt fund would not be too much, because FDs are tax inefficient and debt is only tax efficient beyond 3 years. So unusually, equity becomes long-term in 1 year in India, and it takes 3 years, but it's important for our viewers to take note of that and make sure that the tax efficiency is in their favor.
Okay, all right. Well, we've just got a live caller joining us right now. It's Raj from Aurangabad. Hi Raj, good evening. What's your query?
Hello ma'am, hi. Thanks for taking my question. Myself is Dr. Raj from Aurangabad, Maharashtra.
Hi Dr. Raj, tell me.
Hi, I just want to take the opinion or expert opinion of Mr. Feroze. I'm a fan of his shows actually, and as well as your shows too. See,
Thank you so much.
I have 6 lakhs of SIPs going on per month. I just started them 6 months back.
Okay.
And I have like 1 lakh, these are 6 different SIPs, 1 lakh per SIP.
Okay.
So I just want to take Mr. Feroze's opinion whether my portfolio is right or not. Okay.
Sure.
First is SBI large cap fund.
Okay.
1 lakh. Second is Mirage large cap, which I have started on regarding after his recommendation only. Third is Axis mid cap. Fourth is Mirage mid cap.
Mirai Asset, yes.
Which are just launched in July.
Yes.
Fifth is ICICI multi cap. And sixth is SBI focused equities.
Okay.
So these are like 3 lakhs on my name and 3 lakhs on my wife's name.
Okay.
And my plan is to create a 2.2 CR in the next couple of years and keep invested for next 20 years so that I will have corpus of at least 20 CR after 20 years from the moment I will complete my target of 2 CR.
2 CR. Okay.
So that is I am expecting to protect my capital in a volatile environment as well as get a return of 11 to 12% after 20 years from now.
20 years, yeah. Okay, so okay, yeah. Sorry, Dr. Raj, do you have any follow-ups?
Yeah.
Okay, all right. So basically, he's an ardent follower of you. So I'm sure I don't think you should have any problems with the funds that he has mentioned. But yeah, Feroze, is that a reasonable assumption as well to make? I mean, he's starting off with a particular amount. He wants to reach 20 crores, after 20 years. Or so is his, return expectation as well reasonable?
No, it's very fair.
Okay.
Why is it very fair? Because he's putting 6 lakh rupees a month.
6 lakh, yeah.
So in effect, he's putting 72 lakh rupees a year. So for the first 2.5 years, if he contributed and brought his target to 2 crores, which I think is very thoughtful of him. So once you have a 2 crore corpus, and if it grew at 12%, which is the expected return, the money becomes 9 times in 20 years at 12%. So 2 crores, 2.5 crores into 9 will get him above the 20 crore limit. I think it's very sensible to have those kind of retiral corpuses because 20 years of depreciation in purchasing power of money has to be factored in. I think that's a generous retirement corpus, and I think he'll be able to sustain a lifestyle which he lives today very lavishly, very easily if he actually planned this way, which I think is very, very bright. I think he needs to add 2 more funds. If you have 6 lakhs, statistically we did some research to see that for amounts large enough, 8 funds could be a good mix of funds. I think that's the maximum, but I think his monthly corpus is good enough to actually merit 8 fund portfolio. Okay. Definitely some of the schemes which he has read out are schemes which I have been recommending for long periods of time. A couple of things he can add is definitely Invesco growth opportunities and L&T mid-cap. These schemes have been tested for their future prospect, not just the past performance, and I think they will stay contemporary because their future performance can also be ascertained statistically, at least better than just looking at the rear view mirror. So add them in your portfolio, and I think that will be a more diversified portfolio, which will bring down your risk, because he said that risk is something which is a primary driver of his strategy.
Well, folks, here's what you get, right? When you tune into the Money Show, listen to Feroze, a portfolio that gets a thumbs up from Feroze as well. Kudos, Raj, you've done a great job and reasonable return expectations as well. So keep up the good work. And of course, since you're investing in 6 lakh rupees per month, you can easily fit in 2 more portfolios. 2 more funds. Okay, very quickly, let's take our last caller for today. Vijay from Chinna is joining us now on the phone line. Hi, Vijay. Good evening. What's your query, sir?
Yeah, good evening. This is regarding the hybrid equity funds. Hello?
Yes, go ahead.
I have already invested into 4 hybrid equity funds. One is L&T, SBI, ICICI Prudential, and the 4th one is HDFC. So I would like to limit my exposure to this. So I'm just trimming my portfolio. I would like to keep only 2 out of this list. So would like to take the expert's recommendation on that.
Okay, these 4 hybrid funds, is that all you have in your investment portfolio?
Apart from this, I have small cap, mid cap, and multi cap as well.
Okay, he has a small mid cap and multi cap. So 4 hybrid funds. Firstly, are hybrid funds a good addition in the portfolio? I mean, which ones would you ask him to exit?
See, I think hybrid funds itself as a category for a person who has a reasonable amount of corpus doesn't make sense. Because if you only had 500 rupees to invest and you had actually wanted to take a debt exposure and an equity exposure, 500 rupees is the minimum amount. So I would buy a hybrid fund so that I get a mix of both of them. But if you have invested in so many schemes, it's but obvious that you would be investing in SIPs to the extent of 3, 4, 5,000. So make your equity fund selection separate, make your debt fund selection separate. When we did a research of hybrid funds of a specific asset management company compared with the two good funds of the same asset management company, if bought separately, buying separately was meritorious, at least data says so. Second is when you buy them together, the cost on the debt side also is very high. Which if you bought a separate debt fund, the costs could be lower. And thirdly, I think tax advantage of getting tax-free dividends is also vanished in the equity side. So I think after April 2018, it does not have a compelling case to have any hybrid fund for that matter. So I would ask you to sell all the four and mix good equity schemes of the same fund house if you are already in liking with that, and mix it with a debt scheme. That will be a better strategy. Can give you a 1-2% IRR lift or a return lift over long periods of time, can add up significant corpuses.